Hey deal makers, welcome to the show where it's all about financial freedom with real estate. Let's do this. All right, in this episode, I'm going to talk about the different ways you can become financially free. And there are different ways you can become financially free with real estate, but also getting into franchises, digital marketing, perhaps buying businesses, online trading. And I've tried actually many of these things myself, and some work better than others. Some don't work at all. And some have fundamental flaws that aren't entirely apparent when you get into it. So I'm going to kind of talk about each of those things and hopefully help you make the better decision as you're trying to figure out how to actually replace your income and how to actually do the thing that Robert Kiyosaki talks about in his book, Rich Dad, Poor Dad. So with that, let's get into it. We've done this now for over 11 years, helping people, advising people to how to become financially free in real estate. And I personally have done so many different things myself. I've flipped 3 dozen houses. I've had some rentals. I got into a pizza franchise. I had up to 8 restaurants at one point. I traded options for 18 months at something pretty cool called Iron Condors, which are pretty amazing. I've had a software startup, did a bunch of things like that. And so I have a lot of perspective. I've studied other business opportunities as well. And so let's get into some of these things here. And I think as you're considering some of these different biz ops and real estate strategies, I want you to use a filter for these. And the filter I'm going to use is really 3 things. One is how scalable is the strategy? And number 2, how passive is that strategy? And then what is the risk of that strategy? Those are the 3 things that as I'm evaluating different types of strategies and business opportunities, I want to make sure that I can scale something without working harder and without losing something down the road because of some market event or some legislation that's passed. So with that, let's take a look at some of these. Let's start with flips because I've done some of them. I've done 3 dozen flips in about 3.5 years. And, the thing with flips, they're actually very exciting. And I was thinking, why didn't I get into rentals? And I felt like flips were more lucrative. And maybe they are. The problem is they're not very passive because, as you know, most people can't handle more than 1 flip at a time. It's a lot of work. And so each flip presumably takes about 6 months. So you can do about 2 flips a year, maybe make $30,000, $50,000 a year. Let's say it's 50, so you can make $100,000. And that's pretty cool. The problem is with that, how in the world do I scale that? What if I want to 10x that, right? What do I 10x that? And now flipping, 20 a year is going to be a challenge. And the only way I can really scale that is by working harder. And so in my mind, flipping isn't very scalable as well. If you're not buying, fixing, and selling houses, you're not making money, and that's also not passive, right? So the only way I can really scale is by working harder. So to me, flipping isn't a very good long-term solution if you want financial freedom. Now, what about rentals, right? If you can get each rental to cash flow, let's say $200 per month, which is generous, as you know, right? You want $10,000 per month in income, you need 50 rentals to make $10,000 per month, right? And as you know, managing rentals is not very passive either. You can do maybe for 1 or 2, maybe 5, but once you get to 10 plus or 20 plus, it becomes basically a full-time job. And it's not as easy to put a manager in place because it's very expensive. You're dealing with, part-time realtors that are managing this stuff. And even if you found a professional one, it's going to be more hit and miss. And so it's not very scalable either. It's also not very profitable, which is related to being scalable. Again, I can scale it, but I have to work a lot harder. And so, another popular strategy on the single family house investing space is short-term rentals or Airbnbs. And I really used to like these. I remember 5 to 7 years ago, they were incredibly lucrative. And I know someone personally that basically quit their job just on 2 of these. And in my mind, I equated it almost to the point of multifamily where within 1 or 2 deals, you can quit your job. That's how profitable these were back in the day because the use of these single family houses were shifted. I love stuff like that. When you change the use of something where now instead of having long-term rentals, you have short-term rentals. I love that. The problem is that over the last several years, 3 or 4 years or so, the incomes of these rentals have been down, way down, because so many people got into the market. There's no surprise that if someone's printing money, everybody wants to get into it. And I have a good friend of mine who really built a sizable, I'd say about 2 dozen short-term rentals. And he was crushing it until about 3 years ago when his income started going down because there was more and more people getting into the market. And so the only way to compete is to reduce your income. And if not, your vacancy would go up. And his income went down so low, combined with the rise in interest rates, that he actually started losing money, and he's now desperately trying to sell this real estate in a market that's, well, it's worth less because the incomes are down as well. And so I didn't really love that as well, because it was more of a cyclical, more of like a one-time thing. And just in general, I don't want to do something and spend 5 years doing something and then lose it all, just in general. And this is my problem I have with single family house in general, is that I just don't like how it behaved in 2008, right? I mean, I know a handful of people who built up sizable portfolios like for 5 years, and they lost everything. They lost millions of dollars because of what happened in 2008. No fault of their own. Maybe they used too much leverage. Okay, the way they finance it, fair enough. Maybe they got a little aggressive in the financing, but the point is that market downswing was really bad, and you could not overcome it anyway. So it was lost in foreclosures, and people lost millions and went through bankruptcy, and it took them years to dig themselves out. I don't like that, because if I'm going to spend 5 years trying to build wealth and that's all gone, then it's not really a good strategy either. And so to me, Airbnbs are similar to that as well, because a lot of legislation also got in the way of that. So there was jurisdictions that limited Airbnbs, which is bad. But then, for example, New York City banned it entirely. Like, that's really bad. What is up with that, right? So people have spent millions of dollars buying whatever Airbnb condos, thinking they can make a certain amount of income to cover the mortgage and to make money. And all of a sudden, this law passed. Like, that's not good. So the market is one thing, law being passed that destroys an entire industry, that's not good either. And typically what I find is a lot of new strategies that are new, they're untested, there's really no laws around them, are subject to this legislative risk, I would say. And in that department also is another single family house strategy, which is this co-living strategy, pad splits, for example. Now, I do like this, again, because it just changes the use of a property. I can buy something, even if it's a long-term rental property or primary residence or even an Airbnb, and now using this co-living model, it allows us to boost the income, which is pretty neat. And I can apply Airbnb type strategies with regards to automation and things of that nature. And I like that. There's also pad split themselves provide network for you, so you can actually have property management companies that specialize in managing pad splits and co-living, which is also cool. So I do like it. Again, it doesn't work in every place. For example, it's not going to work very well with an HOA, but the legislative risk is just really high because it's so new and communities don't have rules. It just didn't exist like 2, 3, whatever years ago to a large degree. And so if you start buying, and the next, let's say I'm going to get into strategy, and you start buying 5, 10 houses, right? And all of a sudden a law is passed that forbids that strategy, you can lose your entire portfolio. So I would be cautious with new things unless you recognize that there's a limited timeline on these things. 3 to 5 years, you're going to get in, get out, make a bunch of money and get back out. That's fine if you go in there with your eyes open. For me, I want something that I can spend 5 to 50 years building wealth. So that's really important to me as I'm considering real estate strategy specifically, but business opportunities in general. So let's get into some commercial strategy, self-storage. I actually love this strategy because it is scalable, and it's one of the more recession-resistant strategies, a little bit like multifamily, but it's not as passive as multifamily. Because it's difficult to hire a professional third-party management company. Having said that, though, one of the things I do like about self-storage is that you can use a lot of technology. Everything's done online. There's codes and gates and things and key cards where you don't really need a person at all. But you do need someone's still got to answer the phone, right? Someone's still got to do the financials. Someone's still got to do the marketing. There's some things that need to get done. And the cool thing with multifamily is typically a property management company does all these things, right? They do all the back office, all the bookkeeping and all that stuff, right? There's someone there that handles those work requests. I forgot about that. Repairs that need to be made, calls from tenants, things of that nature. They do everything. They do the marketing. And with self-storage, it's much more difficult to do that. If you study the people who get into the business, while it is a leveraged business for sure, it's vastly better than, running a restaurant, which I'll talk about in a second, right? Once you hire that person that can do those things and answer the phones and make sure that things are done, everything's good until they leave, or you have to fire them, and then who's going to manage the unit, right? It's going to be you. So as long as you recognize the fact that you might be in the business for a little while here and there, until you can maybe hire someone to oversee everything, more like an asset/property manager, then it's okay. But in the beginning, it may be a little tedious with self-storage. And mobile home parks is actually similar It's actually a little bit worse because it's even harder to find third-party management. So if you look at people who are in the mobile home park space, like for example Kevin Bupp, we had him on a podcast recently. He talks about this, right? Because he talked about in the beginning they were self-managing, they didn't have a choice. Then they brought in a third-party manager, and the wheels came off, and they reluctantly came back to self-management. They're like, okay, I guess we're self-managing this thing now, and now they're operating at a very high level. So mobile home parks is that thing. It is scalable, it is recession resistant, but it's hard to manage. As long as you know that you're going to get into the self-management business of self-storage and mobile home parks, all is well. But for me, with multifamily, I don't want to do that, at least not in the beginning. Like I've seen people who are getting into, when they have 1,000+ units, they do tend to self-manage because there's a certain enough scale there. But in the beginning, you really don't, because you really want to hire more of a professional property manager and let them take care of everything for you so that you can continue finding deals and raising capital. That's what I really like about the multifamily side. Let's talk about online trading. You're trading options, currencies, commodities, and crypto. And as you may know, this strategy isn't very passive. As any active trader will tell you, like if you're not constantly watching the markets, you're not going to do well. It is scalable because you can actually use leverage, which is kind of cool it's scalable from a money perspective, but not so much from the time perspective. But of course, that also increases the risk substantially, right? Even if you don't use leverage, a strategy is one of the riskier ones. In fact, trading is one of the most difficult ways to make money, with studies showing that over 90% of traders lose money over time. Now, I did this in the beginning, and when I was trading outright options, it was very stressful because you're really constantly watching it. It was also very exciting. I mean, if you're an adrenaline junkie, online trading is absolutely fabulous, which is why I ended up on iron condors. Iron condors is really where you're selling calls and puts, and you're really, when you sell calls and puts, you actually get paid. And as long as they expire, out of the money, you get to keep the money, which is kind of cool. So you're not constantly watching it. Markets typically over time, they thrash about, they go up and down, up and down. And so it's actually kind of a sit and wait strategy for 30 days. And it requires not nearly as much time, but the downside of that is you couldn't make as much money either. I was making like 7 or 8%, and that really wasn't worth it, right? Because you do have to watch it. If you're gone for like 5 days, that is going to be a big problem. So, while this strategy is very exciting, it really is kind of like flipping houses, very exciting. It's not a great vehicle for passive income. Let's talk about buying businesses or franchises. Now, I kind of lump these together a little bit because I've built and bought franchises in the pizza restaurant back when I got out of my job as a software manager. I was with a company called Web Methods that went public in March of 2000 and put a bunch of money in my pocket. And so when I read Rich Dad Poor Dad, yes, I flipped a couple houses. I took a real estate investing boot camp. I flipped a couple houses, like I said, and I had a rental. I then learned how to trade options. But my big idea was to get into restaurant franchise. And so, I knew, you probably know, the Five Guys Burgers. I did not get into that concept, but Five Guys Burgers came out of Northern Virginia, where I used to live. So I knew a lot of the early franchisees, like, oh, yeah, you just fund the whole thing. You hire a guy to run everything, and you sit back and count the passive income. I'm like, well, that's great. That's what I want to do. I want to count the passive income. And that's exactly what Kiyosaki talks about in his book. And that's exactly what I did. I bought a 10-unit franchise with a different concept. It was a pizza concept. And I hired a guy, a very experienced guy, and he was with me for a very long time. And it went well for about a couple of years until the recession hit. And then it no longer worked very well. Because it was a high-end gourmet pizza chain, no one wanted to pay $25 for a really, really good for you, pepperoni pizza. They want to pay $9.99 with 3 toppings and a coupon for 50% off. That's what happened after the recession. And so the concept really wasn't set up for it. And I, as a franchisee, couldn't really change the concept, though I tried. Could not be done. And so the revenues went back and continued in a downward spiral to the point where I had to let my operator go. And now I'm running 6 restaurants. I'm driving 1 hour one way. 6 days a week, meeting with my manager, put my best effort into it. But it was like trying to catch a falling knife, and nothing I did really worked until I realized I had to sell these restaurants. They cost a lot of money to open, but no one was buying restaurants after the recession, especially when they're losing money. So I basically sold them for, all cash, fast close, if you know what I mean. Just to get out of the thing, and it took a lot longer than I thought it would get out of it. So I know a little bit something about franchises and buying existing franchises, but the thing about it is I set it up as a passive investment. I really did, right? I wasn't really meant to be an active investment, but it turned out to one because of several things. One, of course, market exposure. which I did not know. I did not appreciate that a market correction would have such an impact on the business. Whatever franchise you're considering, what is a market correction? How recession resistant is that franchise, right? And some are going to be more recession resistant than others. Well, a gourmet pizza chain, didn't occur to me that an actual recession would impact that. Now, if I had a Domino's, for example, it would have been much more recession resistant than a high-end gourmet pizza chain, which was doing crazy in 2005, right? So how risky is that investment with regards to market? And then how passive is it, right? How passive it now, theoretically, it was theoretically scalable because I hired a guy right from the beginning. But what I didn't realize is, what if the guy didn't work out or the guy left? Because now you're running the business. Now, the other thing I didn't realize, a lot of these franchises are really meant to work for owner-operators. Like, for example, I know a guy in the Subway chain, and he explained this to me, that typically franchises are meant to be owner-operator. They're not meant to be in a passive investment. It's really a job. Someone wants to work for themselves, and they don't want a 9 to 5. They want their own business, but they're going to be behind the register or the counter doing some sort of thing. And I didn't realize that. Once you actually have to pay a manager, the business model works less for a lot of franchise opportunities, which I didn't realize either. So in other words, you had to make a lot of money, or you needed a large scale for that to work. But again, the big thing is, if the guy didn't work out or the gal, and you got to hop into business, you're now running the business. The same goes for if you buy a business. And this is really cool. I do like the idea of buying businesses, just in general. I like it because it's less risky than starting a new business. So I like it from that. I just want you to go in there with your eyes open, because when you buy a business and it's got someone running it, okay, that's great until that person is no longer running it. That means you're going to have to be prepared to jump in there and run that business for maybe several months, maybe 6 to 12 months, until you can replace yourself or someone else. So it's not really as passive as, for example, multifamilies. If a property management company doesn't work out, there's probably 9 others in the area, and I don't have to train them. I just hand them the keys. Do your thing. You already know how to do this. Do your thing. You better do it better than the guy or gal before. But I don't have to train you, right? If I have a higher GM, I'm going to have to get that person up to speed, watch them, hold them accountable. So it's not nearly as easy to pivot out the person running that business. So just go in there with your eyes open, and fundamentally, bottom line is this: whatever strategy you're looking at, you got to create clarity for yourself. Okay, you got to be clear on what you want. And I wasn't clear on what I wanted either. I did want financial freedom, but I wasn't really clear about what that meant. In other words, I thought that getting into the franchise business, it was my ticket to financial freedom. And it was, but I didn't consider the downside. I didn't consider any kind of market risk. I didn't consider operational risk. What if my guy were to leave, right? I didn't consider any of that. I looked at my spreadsheet and numbers, and they were fantastic. I could scale this to 20 units and print money, right? And so same thing for my flipping business, right? Flipping business, it was super lucrative, but I didn't realize the fact that it's a lot of work to actually flip houses. If you're not constantly buying and fixing and selling, you're not making money. So I wanted financial freedom, but I didn't really clear about what that meant. So what I'm telling you is, if you want financial freedom, whatever you're looking at, whatever strategy you're evaluating, look at it from a lens of how scalable is it? Can I grow this? Like, can I really build wealth? Can I make $1 million+ with this? And number 2, can I do it without having to work harder? So what I mean by that, in multifamily, for example, I can buy a building, whatever it is, a 50-unit building, and yes, it's a lot of work to close it, and then 90 days, you're getting a proper manager, and it's a lot of work. Okay, but it's not a lot more work than doing a burst strategy, right? When you're buying a house, you still got to do your due diligence, you got to do inspection, and then you got to do a bunch of work, find a tenant, and then refinance. Still a lot of work, okay? And so with an apartment building, the difference is that you just have a more professional, a bigger team to help you do heavy lifting, which you don't need so much on a single family house. The point is this: so when you buy a multifamily, there's quite a bit of work involved, but then after about 60, 90 days, when it quiets down because your property manager has got it. Therefore, it now frees you up to do it again, right? And then you do it again and again and again. And this is how you can really build massive wealth, so you can actually scale our portfolio with a relatively small team. I mean, we have $300 million in real estate. We have a team of 6 and a couple of VAs, right? So you can probably build a $100 million portfolio with you and a partner and a VA or 2, right? So if I had a $100 million franchise, I'd have a team of 80 people under me, right? So the level of effort, because of the way it's set up, because you have professional property management built into the business model, right? Because you're using title companies and attorneys and CPAs, because your revenue is higher, you have more ability to actually hire out all the work. And that's a key component of how passive something is. You can achieve scale much more rapidly. And then the last thing is look at the risk, right? Because when I got started in business, I had big old happy years on, and I never even thought about it. And I know that because I was personally signing leases left and right. What could possibly go wrong when I'm getting into the restaurant business, signing a 10-year lease, right? It never occurred to me that if something were to go wrong and I couldn't pay my rent anymore, that they can actually, they could come after me personally. They could literally take my cars, my houses, and my firstborn, right? I had no idea. I didn't even try to negotiate that out. I didn't even try to limit it in any way. I just happily signed 8 leases in total, which is wild, right? So really look at the downside. Look at particularly the market risk, the legislative risk, like we talked about it earlier. And we talked about the operational risk as well. How can you mitigate those things? Some things you can't control. You can't control the market risk per se. You can't really control the legislative risk per se. You can if you get into a strategy that's been around for a little while, that's been tested in the courts, for example. So really look at it from a risk perspective as well. What could go wrong? How long has the strategy been working, or is this kind of a new strategy? And then maybe you in your mind, you classify it as something a little more speculative. Maybe you're like, oh, I got a 5-year runway. But just make sure you go in there with your eyes open. So those are some of the things to think about as you're evaluating different real estate strategies and different business opportunities. So hopefully you found that helpful as you're trying to figure out, hey, what can I do to become more financially free and quit whatever I'm doing and build generational wealth? So if you want to take the next step with financial freedom in real estate, then check out our resources on thefreedompodcast.com. On that page, if you're just new and you want to learn about multifamily investing, then check out our free masterclass. It's called Apartments 101. It's a 45-minute free training course. If you're like, I really want to get started with this stuff, but I could use some help, then why don't you book a call with us and let's explore working together with our experienced team to help you get into the business and get started yourself. So that's all at thefreedompodcast.com. Appreciate your time here being on here today. I'll catch you on the next episode.